Welcome to Earnings Intelligence, where we break down the stories hidden inside financial reports. Today, we're diving into a landmark quarter for Berkshire Hathaway, the first quarter of 1996. Okay, let's just jump right into it. On the surface, these numbers are, well, they're kind of crazy, right? Net earnings per share went from $118 to almost $1,400 in 1 year. That's not just a little bump. We're talking about a more than tenfold increase. So you gotta ask, right? How does a company suddenly become 12 times more profitable? I mean, did they find a magic money tree, or is there something else going on under the hood here? That's what we're gonna dig into today. We're gonna peel back the layers of this report and find out what's really driving this spectacular number. All right, so here's how we're gonna break it all down. First, we'll tackle that crazy headline number. Then, we'll unpack a huge one-time gain, find the real growth engine for the quarter, check in on the rest of the business, see a big move they made for the future, and then wrap it all up with the big lessons we can learn from it. Okay, first up, let's take a closer look at that spectacular headline and try to figure out what's really going on. I mean, just look at this chart. You go from $139 million to over $1.6 billion. That's not just a jump, that is a rocket launch. So the big question is this sustainable? Can they keep this up? To figure that out, we have to pop the hood and look inside, and that brings us to the first big piece of this whole puzzle. And it turns out, pretty much all of that massive increase came from one single event that isn't gonna happen again. So, right there in the report, you see this line item, a pre-tax realized investment gain of $2.2 billion. Now get this. That one number is actually bigger than their entire net earnings for the quarter. So, where in the world did that come from? Well, it all came down to a huge corporate deal. You see, Disney went and bought the media giant Capital Cities/ABC. Now, Berkshire had been a major shareholder in Capital Cities for a long, long time. They'd bought their stake for just $345 million way back in 1986. And now, poof, that investment was suddenly converted into $2.5 billion of cash and new Disney stock. And this is a really, really important distinction. The gain was realized, but it wasn't created in Q1 of 96. It's kind of like this. Imagine you bought a house years ago for, say, 50 grand. Today, it's worth $500,000. That huge jump in value, that's an unrealized gain. It's just on paper. But the second you sell that house, all that paper profit becomes cold, hard cash in your bank account. It's now a realized gain. That's exactly what happened here. And you know what's great? Berkshire tells you this themselves right in the report. They basically put up a big warning sign for investors saying, and I'm paraphrasing here, hey, don't get too excited about this giant number. It has no predictive value. It's a one-time thing, so don't expect it again next quarter. So the main takeaway here is this wasn't really new money made in 1996. It was just 10 years of growth finally getting cashed in and put on the books. It's a big deal for sure, but it's not the real story of what made this quarter so important. All right, so if that huge $2 billion gain wasn't the headline act, then what was? Well, the real game changer, the true strategic masterpiece of this quarter, was a huge acquisition, one that would basically define Berkshire for years and years to come. Literally on the second day of 1996, Berkshire dropped $2.3 billion to buy the rest of GEICO. You know, the car insurance company. They'd actually owned about half of it for a while, but this move, this decision to go all in and take full ownership, it completely transformed their entire insurance operation. And the effect was immediate and just staggering. I mean, look at their insurance premiums. They shot up from $231 million to over $900 million. And almost all of that jump was just from bringing GEICO fully into the fold. Now that, unlike the Disney deal, is real, repeatable, operational growth. But you know, the premiums, that's only one piece of the puzzle. This deal brought something even more powerful into the Berkshire machine, an extra $2.5 billion of something called insurance float. Okay, so insurance float is basically Berkshire's secret weapon. Think about it. You pay your car insurance premium to GEICO every month. They take your money right away, but you might not get into an accident and file a claim for months or even years. So what happens to all that cash in the meantime? Well, Berkshire gets to hold on to it and invest it for their own profit. It's like getting a giant zero-interest loan from all of your customers. It's absolutely brilliant. So that's the key difference, right? The Disney deal was a fantastic payday, a profitable exit, but the GEICO deal was a strategic entrance. It was all about loading up their war chest with billions of dollars of capital that they could use to invest for decades. That was the real engine of this quarter. All right, so Section 4, beyond the big deals. Because, Berkshire owns a lot more than just stocks and an insurance company. Let's see how the rest of the universe was doing. So if you look at their other businesses, everything from See's Candies to Kirby Vacuums, revenues were actually up a pretty solid 22%. And the report says that's mostly thanks to a couple of recent purchases they'd made, Helzberg's Diamonds and R.C. Willey Home Furnishings. But check this out. This is what's really fascinating. Even though revenues were up 22%, their actual profits were totally flat. And they're pretty honest about why in the report. They said that while the new companies were doing well, some of their older businesses, like their shoe and newspaper segments, were struggling. It's just a great little snapshot of the reality of running a diverse company. Not everything is booming all at once. Okay, on to our next section, opening the doors. So after this monster quarter that really put Berkshire's value on display, they made a really smart, forward-thinking move to change how the company itself was structured. Right after Q1 wrapped up, they got the green light from shareholders to create a new type of stock, what we now know as the Class B shares, or the baby Berkshires. And the whole reason for this was simple. The main stock, the Class A shares, had just gotten way too expensive for the average person to buy. This was their way of opening the door to a whole new wave of investors. So let's wrap this all up. What are the big lessons from Q1 1996? I mean, this report, even though it's decades old, is basically a perfect textbook on how Berkshire thinks. First, you've got to look past the flashy headline numbers. You have to learn to tell the difference between a one-time windfall and a real sustainable business engine like GEICO. It teaches you the incredible power of insurance float, and maybe most importantly, that the best strategic moves aren't always about the biggest short-term profit. They're about building a fortress for the long haul. So in the end, this report shows us a massive one-time gain. But the real story, the important story, is about a game-changing acquisition. And it teaches us what might be the first rule of smart investing. Always, always look past the headlines. The big number is just the cover of the book. You have to be willing to open it up and read the story inside to really understand what's going on. Thanks for joining us on Earnings Intelligence.